I think this is the point behind a contracting economy in Germany. A contracting economy in Germany basically means that relative to the capital that Deutsche Bank actually has, the losses that it could accumulate on its balance sheet could easily wipe it out. This is the other side, if you like, of fractional reserve banking. And it is a feature of every credit crisis. I mean, the banks come under huge pressure. They start moving from a position where they have been making money by gearing up their balance sheets to losing it incredibly rapidly, and they need to get out while they can. So that, this is why these events tend to be a crisis rather than something that generally that sort of gently evolves.
As a responsible person with growing concerns for your privacy and personal liberty, you want to know where we're headed and what you can do about it. We ask the experts what you need to do to take prudent and responsible action to safeguard your family's wealth and well-being, and what basic first steps will help you to be aware and prepared. ReluctantPreppers.com.
Reluctant Preppers provides educational awareness and commentary only. Opinions expressed do not constitute personalized financial advice. Viewers are encouraged to do their own research and seek qualified personal financial consultation before making investment decisions.
Welcome back, Reluctant Preppers. We're privileged to have this returning guest. AlasdairMacleod is the head of research at goldmoney.com. He recently penned an article about the ghost of failed banks returns, drawing the lines between the repo action, unprecedented in some ways by the Federal Reserve, and the potential failure of Deutschebank, a linchpin of the Eurozone. Today is Monday, September 30th, 2019. Alasdair, thanks for joining us again here on Reluctant Preppers.
No, that's my pleasure, DK.
Your article really raised some eyebrows. People have been talking for the last 2 weeks about this rather unexpected rush of capital injection. In other words, money stolen from the U.S. taxpayers without their consent and injected into the banking system for some unexplained reason. The first day it happened, we were told $75 billion was necessary just because a lot of banks were needing some cash to cover their quarterly tax obligations. But then it happened the second day, the third day, and on and on. And we were told it may be going on until at least October 10th, or some say, who knows. So you've been doing some research into that. Could you tell us what you've been uncovering as far as the potential reasons driving this rare action by the Federal Reserve, and that it doesn't seem to bode well for the health of the banking system, specifically in the Eurozone, but with implications globally?
Yes, absolutely. I mean, my starting point in analyzing this is the belief, and I think this is correct, that the Fed generally knows what it's doing in the repo and the reverse repo markets. For the last 6 months, a year, something like that, the Fed has actually been increasing its reverse repos. Now, what this means is that it has generally seen a bit too much liquidity in the banking system, so has been gently withdrawing it. We then have this crisis. Now, it seems to me that if the Fed detected that there was general liquidity within the system, then this crisis, which has shown up in the repo market, actually has nothing to do with the general liquidity level in the system. Far more, it's likely to do with one or more banks needing liquidity and the other banks not prepared to offer it. So we have this situation where there is a problem, if you like, a systemic problem rather than a general problem. Now, it just so happens that the deal which was agreed in outline between Deutsche Bank and BNP, whereby Deutsche Bank sells its prime brokerage business to BNP, that was originally announced back in July. And we know at the time from various articles like Bloomberg and I think the Financial Times as well, that hedge funds were beginning to withdraw funds from Deutsche Bank at that time. And a rate of around about $1 billion a day was mentioned. Now, Deutsche Bank has a very, very large balance sheet, and I guess that it wouldn't have too much problem either covering the withdrawals of $1 billion a day, or alternatively going into the repo market and covering it that way. So that wasn't a problem. But then this deal was actually consummated in the week that the the repo problem arose. So we have a situation where the transfer of ownership goes to BNP, but what happens to the deposits on Deutsche Bank's balance sheet, which is related to its prime brokerage business? The answer appears to be it has not gone necessarily to BNP. It has come off Deutsche Bank's balance sheet. So there needs to be some rebalancing. Now, put yourself in the shoes of an American bank, an American prime brokerage. It would see deposits coming from Deutsche Bank or from BNP, but particularly Deutsche Bank, and Deutsche Bank then going into the market and trying to raise significant amounts of overnight money through the repo market. So what do? You say, well, is this a risk I'm prepared to take? And you probably on the margin say, I would rather not get involved. And I think that was the origin of the problem that Deutsche Bank faces. So that's the repo situation as I would read it. There are other factors which have been mentioned to me. One is that China is withdrawing deposits from the American banking system. I don't know if this is true, but it's certainly rumored, and I heard this from a professor of economics in China as a possible cause. But I don't see any pressure, if you like, on the exchange rate, which I would have thought would be the case under those circumstances. Another thing that has been mentioned to me is that the blow up of the refining capacity in Saudi Arabia means that Saudi Arabia is probably selling dollars to replace the dollars it would have earned from oil sales because it's a very, very as a government, it just spends a hell of a lot of money. So that could have been another source. But again, we see a strong dollar. So I don't really think that either China or Saudi Arabia or a combination of the two are producing a sudden shortage within the repo market, or which is reflected in the repo market. So I come back really to the most likely cause of this being a dislocation created by the transfer of ownership of Deutsche Bank's prime brokerage business to BNP.
It's interesting. We had an article back at that time, interview entitled "Deutsche Bank is Getting Out First." It's interesting that it sounds like that transfer could be causing disruptions in the availability of capital where it needs to be. If your title of the article, though, "The Ghost of Failed Banks Returns," implies that we've seen something like this before. Can you draw the parallels for us?
Yes, of course. I personally saw a parallel on this because in this country back in 2007, we had a problem with a bank called Northern Rock. Northern Rock primarily was a mortgage lender for the equivalent, if you like, of the American Liar loans. They were lending money at 125% of value. So this was very, very risky stuff. They were funding themselves very substantially out of the money markets. And I think it was in September 2007, they first went to the Bank of England for a bit of help, if you like, to balance their books. Now, that December, I happened to be in the offices of a money broking firm called R.P. Martin, and suddenly I was informed that all of the offers in the LIBOR market had been withdrawn, and so there was some sort of panic on. Now, I had, if you like, as an Austrian economist, expected this to happen for some considerable time. So I took this as a very, very important signal. And it was within 2 months that Northern Rock had to be nationalized by the government. In other words, rescued by the government because it had simply failed. So the timescale between the two was actually almost exactly 2 months between me seeing the freezing up in the LIBOR market and Northern Rock actually going under. We have, so I'm sort of, you can understand why I would see a parallel with this repo dislocation and the situation for Deutsche Bank. Now, Deutsche Bank it's been known for some considerable time that Deutsche Bank has had a lot of problems. Those problems haven't necessarily been very well defined, but there have been enormous efforts for Deutsche Bank to withdraw from from international markets, indeed, which is one reason why we have this repo problem. But on the domestic scene, it is not in a very good condition either. And if you look at its main rival, which is Commerzbank is equally in a very, very sorry situation. So we can see the two largest banks in the German banking system, for various reasons, have enormous problems and are probably struggling very hard just to keep alive. Now we have a further problem, and that is that the tariff war between America and China has effectively killed Germany's growth market. So you can see that the German economy is entering into recession. Now, this does mean that the German banking system is going to come under even greater pressure. So if we factor this into the whole thing, let's assume that we are in the management of a major American bank, and we see the German economy really tipping into recession and looking like, the last set of figures for the PMI were subtext. Subtext was simply awful. So everyone in the banking system knows that the EU is in trouble, Germany is in trouble, and the German banks are in trouble. Would you want to be a counterparty to a German bank under these circumstances? And I think this is basically Deutsche Bank's overriding problem. The other bank, which I quoted as a ghost, if you like, returning, was Kreditanstalt, which was the Austrian bank, which back in 1931 had to be rescued by the Austrian government, and it finally failed in 1933. That failure in a relatively small country, it was the major bank in a fairly small German-speaking country, actually tipped all the economies around it into recession, protectionism, and drove them off the gold standard. This time we have a far larger bank with a derivative exposure which didn't exist in the 1930s in a far larger country, creating similar waves. So this, I think, could well be the source, if you like, of the next Lehman, if you like, the next real crisis. Hopefully not, because this is a very, very serious issue. And I must say that what I'm saying is supposition, not actual fact, but it is supposition that can be reasonably deduced from the facts that we have. Now, that being said, you can understand why an American bank operating in the repo market in America would be reluctant to enter into more counterparty risk with Deutsche Bank. So that, if you like, is the whole thing. So I can see two ghosts there. I can see Northern Rock, which is the more recent death, and also Kreditanstalt, which takes us back to the last really major credit crisis, which the coming credit crisis, on a combination of the previous credit expansion failing plus trade tariffs, could well replicate what happened in 1931.
It's interesting because you had visited us a couple interviews back saying that we're getting trade protectionism just at the top of the credit cycle, in a very overripe credit cycle. And this certainly seems like an ominous development along the way as we're watching with some concern the health of the credit markets. The timeline was interesting that you mentioned in the, what was the name of the bank?
Yes, Northern Rock.
Yes, of just a couple of months between when the symptom that you saw showed up and when implications that it had on the overall system. What kind of a do you have reason to believe that the injections of capital by the Fed here will be able to significantly paper over this? Because in your article you said there's not really a lot that the Fed can do. Can you explain to us what you mean by that?
Yes. I think in the in the immediate future, the Fed can't paper over the cracks. And that indeed is what they're trying to do. What they're trying to do is, instead of Deutsche Bank forced to pay huge great rates or unable to fund itself, the Fed is actually feeding the money to it. I mean, this is as it would appear to me. So I think, yes, the Fed is papering over the cracks, and the issue could well go away. I mean, a lot of people have tied this to quarter end and all the rest of it. I don't know, that may or may not be an element. But what tends to happen is that something like this disappears out of the headlines for a little while, and then it comes back later, maybe in a different form. I think the real issue with a Deutsche Bank problem, if this is what we have, is the attitude of other bankers. If other bankers are really concerned, as I suspect they are, with the counterparty risk from Deutsche Bank, then the problems of Deutsche Bank could actually escalate quite rapidly. Because remember, you've got a mountain of derivatives there. You've also got synthetic ETFs. Now, Deutsche Bank itself runs, I think, something like 29 or 30 billion dollars worth of synthetic ETFs. And what a synthetic ETF means is that Deutsche Bank will hold, separated from its balance sheet, assets, and the assets should be cash, near cash, and short maturity bonds. The problem with an outfit like Deutsche Bank is you don't know the character of the short maturity bonds that back your synthetic ETF. If it, as many have suspected, banks who have ETFs completely in-house use them as a dustbin for the bonds that they can't actually dispose of readily in the market, then there is implied a lot of counterparty risk in there for the ETF. And I can just see that this could spread to a wider problem within the ETF market. So that is, I think, another consideration which your listeners should really keep an eye out for very closely. I don't think it affects all synthetic ETFs. There are independent managers of ETFs who are aware of these risks and actually control them. They are not told by anybody that you must take this bond, as it were. So I don't think it affects them all, but this could actually create a problem in certain areas.
It's hard to for the ordinary person to understand the full implications of all this, but certainly the level of interdependence and the magnification of the effects of certain shortages because of leverage and derivatives and so on, exposure between the banks certainly seems to magnify the potential implications of this.
Yes, absolutely. And I think this is the point behind a contracting economy in Germany. A contracting economy in Germany basically means that relative to the capital that Deutsche Bank actually has, the losses that it could accumulate on its balance sheet could easily wipe it out. This is the other side, if you like, of fractional reserve banking. And it is a feature of every credit crisis. I mean, the banks come under huge pressure. They start moving from a position where they have been making money by gearing up their balance sheets to losing it incredibly rapidly, and they need to get out while they can. So that, this is why these events tend to be a crisis rather than something that generally that sort of gently evolves.
Well, we'll appreciate your help going forward, looking for signs that will be indicators and signals to the rest of us. Hypothetically correct, one of our viewers asks, after the international confidence in the U.S. dollar is fully lost, how long would you say it would take for American people to realize the shift, and what signs could informed Americans point to that could enlighten the uninformed about what is happening?
Well, I think it was Lord Keynes who said that not one man in a million understands money, and that actually is the strength that central banks have. They can print like Billio. Banks can issue credit and expand credit like Billio as well. And, the ordinary person just doesn't understand. So on that basis, you can find that it might take, depending on the circumstances, it could take a year or two or three or four maybe before the dollar really collapses, if it collapses completely at all. I mean, you have the similar situation really in countries like Argentina and Their currency has been in a state of collapse almost forever, but it never quite sort of falls over. The timing is very, very difficult to know. But there is a new factor in this, which I think is worth mentioning, and that is cryptocurrencies, particularly Bitcoin. Bitcoin has educated a new generation of millennials into the vagaries and the disadvantages of state money as far as the ordinary person is concerned. So there is a generation who do understand money. In a way in which Keynes, wasn't true when Keynes made his comment. So on that basis, it could be that some of the more enlightened people in your country make it more difficult for the Fed to conceal what's happening to money when the pressure really mounts. So, and that, if I'm right about that, then that could change the timescale quite radically. The other thing that could change the timescale is if the Fed makes the mistake of introducing negative interest rates. I mean, even at zero interest rates, if they're zero and they look like they're going to go negative, then technically what you're doing is you're putting the whole of the commodity complex into a backwardation. And the backwardation is coming from the money side, not the commodity side. So what happens then is that people will move out of deposits into commodities. And that will, if you like, well, it'll do two things. It'll push down the purchasing power of the dollar, and at the same time, it will increase demand for hedges such as gold, silver, other commodities, and also potentially Bitcoin.
Mark Robinson asks, what happens to the money market funds when liquidity dries up? People don't realize that many times your broker puts your, quote, cash in money market funds, and this can be dangerous.
Yes, that's right. Well, it's going to depend on the Fed. I mean, what we do know is that the Fed will not let the system fall over. It'll do everything to make sure that the financial system survives. And of course, money market funds are all part of that, and a very important component of it. So I think the Fed will always ensure that the money market funds don't break the buck, which I think is the term. But what the buck buys at the end of the day is actually the question you should really be asking, because under those circumstances, the dilution of the purchasing power of the dollar through the increase in its quantity will work through and will have a major effect on people's savings, the value of their deposits, and also the value of their wages, where they are wage earners.
Okay, so just so I understand, you're talking about if there's a flood of easy money creation by the central banks, this sea of newly created money can cover a myriad of sins in the system, but the direct impact on ordinary savers and earners is a loss of purchasing power.
Yeah, absolutely, yes. I mean, the effect on them is perhaps indirect in the sense that they find out afterwards rather than as it happens, if you see what I mean. Mm-hmm. But no, that's absolutely right.
We have a rather interesting question from Eli Redshirt, who says, in your opinion, with the loans and financial problems in Germany and how this is affecting Deutsche Bank, do you think that Germany may want to take Britain's lead and possibly want to exit the EU too? Just wondering if there are other European countries wanting to go take their currency out of the EU.
Well, that's a fascinating question, because the central problem in the ECB, it seems to me, is that Germany's savers are being crucified on the cross of the euro. And I don't know if your listener was aware of this, but the last German representative on the executive board of the ECB declared her resignation at the end of this month. So, or I think probably the end of November. So this looks to me like, the people in the Bundesbank do not like what's going on. They haven't liked what's going on at the ECB at all. Of that, there is no doubt. But I think that animosity is growing. And this could, unchecked, lead to a situation where there is if you like, a fracture within the ECB system. Now, quite how it gets resolved, I don't know. But the possibility of Germany leaving, I think, is likely to increase. And she may well reintroduce the Deutschmark. But the problem here is that you've got two factions within the Bundesbank. You've got the hard money people who are actually, I think, probably in a minority now. And you've got the if you like, the sort of the new macroeconomic central bankers who believe in stimulating the economy, believe in managing the exchange rate lower to keep exports going, and all this sort of rubbish. But I have no doubt that the resignation of this lady from the Executive Council of the ECB is actually a very, very important development, and something that your correspondent here has, if you like, anticipated.
We have another question from Hypothetically Correct, who says, there are some who think local, state, and federal governments will lose control once the crisis of realization begins. Do you believe so?
Well, I think it's a slightly difficult one to answer because losing control, I think your correspondent is probably thinking in terms of money at this stage.
Perhaps so, although I should have. There's a follow-on second part that says, do you believe so? If not, what tactics will they use to keep people controlled? If so, what alternatives would people have to access to an immediate and long term? So I think there's both the implications of keeping money controlled, but also keeping the sentiment of the people in check.
Well, it's sort of, yes. I mean, it goes from manipulating money to a more direct control over human behavior, if you like. I mean, the first thing to say is that sort of control becomes completely counterproductive. You might see it by the introduction of price controls, for example, wage controls, things like that, to try and, and protectionism to try and protect jobs. That always fails. So I think the only thing it does is it buys time while making things a lot more unpleasant for everybody. I suspect it will happen one way and another, but on a more cheerful note, I mean, if you read through history, we've had some pretty rough times in the past, and we always get through them. I think the thing to do is just be, sort of prepared, understand what is happening, and insulate yourself as much as possible from the downside.
This brings the question back to your home. Captain Birdseye says, do you suspect that Britain attempting to leave the EU has anything to do with the eventual collapse of the fiat currencies?
It's a nice one, Captain Birdseye. I don't think I would say that. The collapse of the currencies is actually a secondary effect. The first thing we are likely to have is a credit crisis. It is the response to the credit crisis that will be monetary inflation, which will lead to the collapse, I think. The problem we have is that while we are in the EU, I'm talking about the UK now, we do have a potential liability which could be enormous if other people don't pick up, don't pay for it. I mean, potentially someone's come up with a figure of about £450 billion, which is around about $500 billion. Now, that's not necessarily correct, but it also ignores the counterparty risk we have with a failing EU system, because we've got our own banks here, and our banks are international and they're very, very large. So the cost is enormous. And I think it would be nice if we got out of the EU before the collapse, but we would not be insulated completely from it. And I think, coming back to the question, I don't think that us leaving would actually precipitate it. There may well be concerns, if you like, about trade and so on and so forth. But my view at the moment is that the way the trade issue will be resolved is that we will come out and implement, with the agreement of the EU, GATT Article 24. Now, what that permits is, if there are two nations changing their trade treaty arrangements under GATT 24, they can agree to continue with the current situation until such time as the future treaty is agreed. So I would have thought that something on those lines is quite likely.
Interesting. We have a question coming out of Eastern Europe. Greg Zoltán Botos from Hungary says, recently the Hungarian forint which has been pegged to the euro, has been devalued against both the euro and the US dollar. Our economy is said to be one of the best growing in the EU, which at this moment isn't too difficult. Could this have something to do with a possible relationship to Deutschebank?
I don't see that. No, I mean, if the Hungarian currency is being devalued, as it were, then what that implies is there is a price advantage being put on to Hungarian production. There is the prospect of price inflation, however, from imported goods. Now, having said that, the figures then reflect, if you like, monetary inflation at a higher rate than in either the EU or in the US. So the figures, the problem I always have with government figures is that anyone who believes government figures is actually a fool. So, but the argument that by devaluing the forint you can actually get an advantage on everybody else is at best only a very, very temporary thing. It might show Hungary's economy looking stronger, but I mean this is measured in devalued currency. So I think what really matters is how are things on the ground. Now there will be winners and losers in that. But you just have to make an overall assessment as to how things are going on in Hungary as a whole and judge it from that point of view. But I would have thought that, with inflation, I mean, one of the problems with inflation is that you transfer wealth from the productive side of the economy to the state. And so any apparent advantage or benefit is likely to prove very, very temporary.
Question again regarding, you mentioned commodities of increasing importance during times of cash stress. Jack Robert says, I've heard your gold versus assets time preference theory. What effect on the world would it have? War for commodities?
Yeah, I mean, the thing that's interesting is that the time preference for gold, if you go back to the times when gold was actually used as money or backed gold representatives, in other words, you could exchange your dollar for gold freely. The interest rate for gold was around about 2%, 2 to 3%, maybe a little more in times of stress. That informs us that is the time preference. So if you reduce interest rates, like, fiat currency interest rates to zero, in effect, you've already got a notional backwardation of around about 2% running against gold. Probably what matters as far as the gold price, as much if not more than that, is the prospects for interest rates. If the market begins to anticipate that interest rates are going to rise, then that time preference starts working less favorably for gold and could, if interest rates rise enough, begin to work for the paper currencies. So, but the situation we're coming up to, if I am right about the mixture of trade tariffs plus the top of the cycle, meaning that we're heading for a really very, very difficult recession over the coming years, even without the credit crisis, then under those circumstances, even if dollar interest rates only go back to the zero bound, we will see pressure from the establishment, from Japan, from euros, and all the rest of it, for yet lower rates. For the models will be saying that the rate in dollars should go negative. When you build that factor into the markets, into commodity markets, then you will certainly see a tendency for people to get out of dollars, if you like, cash dollars, deposit dollars in the banks, and to acquire commodity exposure instead, where there is a higher notional interest reflecting time preference.
This has been quite illuminating, and folks, we're going to put a link to Alasdair's article in the description of this video. Alasdair do you have time after this to stick around for a bonus question for our Patreon subscribers?
Yes, indeed.
Great. We've been speaking with AlasdairMacleod, Head of Research at goldmoney.com. Alasdair, as always, thank you for joining us here on Reluctant Preppers.
That's very much my pleasure.
It seems so hard to order. Who can I trust, and how do I even start?
Oh, you just go to sdbullion.com/rp, pick out whatever gold or silver you want, add it to your cart, you can check out, and it's on its way. And they're A+ rated by the Better Business Bureau.
Wow, it's that easy?
Your first ounce of silver is at spot price, and you get free shipping on any order over $99 at sdbullion.com/rp.
After I order gold or silver, how can I trust I'm going to get it? And I don't want everybody to know that I'm ordering gold and silver.
Oh, it's okay. It's fully insured, it's trackable, and you have to sign for it, so nobody else is going to get it but you, and it comes discreetly packaged. If you order a small amount, like maybe gold, it'll probably come in a box that looks something like this. Okay. And if you order a large amount, maybe like silver, it'll come in a box that looks something like this.
Wow.
But it doesn't say gold or silver on there. It might say something industrial or something else like that, but nobody's going to know what you ordered.
Oh, that's great to know.
Your first ounce of silver is at spot price, and you get free shipping on any order over $99 at sdbullion.com/rp.
If I own gold or silver, how will I ever be able to spend it?
Oh, sure. Well, consider good times or bad times. Like in good times, you can sell it back to the same place you bought it from. sdbullion.com/rp will buy it back at the best price guaranteed on the internet. You can take it to a local coin shop and get cash in your hand, completely anonymous. Some people you know may be willing to take gold or silver coins in exchange for goods or services. Now, in bad times, when things have really fallen apart, time after time in history, people have found that in hard times, gold and silver really does come through as something that people recognize as value even after everything else has failed. Your first ounce of silver is at spot price, and you get free shipping on any order over $99 at sdbullion.com/rp.
What if gold or silver drop in price after I order it?
Well, everything fluctuates with time, but nothing is held up longer and better than gold and silver throughout all the changes that have happened in history. Your first ounce of silver is at spot price, and you get free shipping on any order over $99 at sdbullion.com/rp.
What good does gold do me anyway? I can't use it for anything.
Well, I think I found a form you might appreciate.
Wow. That's beautiful. Wow, I can wear that just about anywhere.
And you can take it with you through airport security and across borders. It's small and compact and lightweight, and you can even hand it down through generations. Your first ounce of silver is at spot price, and you get free shipping on any order over $99 at sdbullion.com/rp.